When we think about taxes, most of us just kind of sigh. We see it as this chore we have to do every year, a necessary evil, right? But what if we flipped that script completely? What if, instead of being a drag, your tax strategy became one of your single most powerful tools for building and protecting your wealth? Well, that's exactly what we're going to break down. So let me just ask you this straight up. Are you absolutely sure you're not paying more in taxes than you legally have to? It's a really simple question, but honestly, the answer could be worth thousands, maybe even hundreds of thousands of dollars over your lifetime. And the difference? It almost always comes down to one thing: having a plan. And the stakes here are, well, they're incredibly high. Just look at this number. Without a proper estate plan, the wealth you've worked your entire life to build could get hammered with a tax rate as high as 40%. 40, all before it even gets to your family. That's a huge, huge loss that, frankly, is often completely avoidable. Okay, so here's our game plan. We're going to start with the foundational stuff that works for everyone. Then, we'll get into specific playbooks for investors and for business owners. After that, we'll cover how to lock in your legacy, and maybe most importantly, how to do all of this while staying off the IRS's radar. All right, let's dive right in with the bedrock of any smart tax plan. These are the strategies that everyone should be thinking about. It doesn't matter what your income is or what you do for a living. You first, and honestly your most powerful line of defense, is maxing out your tax-advantaged accounts. Look at the numbers for 2025. You can stash away up to $23,500 in a 401k, plus an extra $7,500 if you're 50 or over. For an IRA, that's $7,000, with another $1,000 for catch-up. And please, do not sleep on the health savings account, the HSA. It's the only account with a triple tax benefit. Seriously, maximizing these is non-negotiable for tax efficiency. Now, inside these accounts, you've got a really important choice: traditional or Roth. It's the classic pay the tax now or pay the tax later decision. With traditional, you get the tax break today. Your contributions are pre-tax, which lowers your taxable income right now. With Roth, you pay the tax up front, but then all your qualified withdrawals in retirement are 100% tax-free. So which one's right for you? It really just depends on if you think your tax rate is going to be higher now or later in life. All right, so if you're investing in a regular taxable brokerage account, listen up, because this part is for you. There are specific rules you can use to protect your portfolio's growth from taxes. It's all about playing smarter, not just investing harder. The first play in the book is something called tax loss harvesting. Now, this has nothing to do with timing the market. It is purely a tax strategy. Basically, you strategically sell an investment that's down. Now, why on earth would you sell something at a loss? Well, you use that loss to cancel out the gains from your winners, which erases the tax you would have owed. It's an incredible way to turn a bit of market volatility into a real tax-saving opportunity. Let's just walk through a quick example. Let's say you sell investment A and you realize a $30,000 loss. Bummer. But you also sold investment B for a $25,000 gain. Sweet. Instead of paying taxes on that gain, you use your loss to completely wipe it out. Boom, you just saved almost $4,000 right there. Plus, you still have $5,000 in losses left over. You can use up to $3,000 of that to lower your regular income, saving you another $1,000. The rest, it just carries forward to next year. That's a total savings of $4,800 from one smart move. But, and this is a big but, there's a catch. It's called the wash sale rule. The IRS says you can't claim that loss for taxes if you turn around and buy the same thing or something substantially identical within 30 days. So for example, you can't sell an S&P 500 ETF to get the loss and then immediately buy a different S&P 500 ETF. You have to wait out that 30-day window to make sure the loss actually counts. Okay, shifting gears. For all you entrepreneurs and business owners out there, your single greatest tax-saving tool might be something you chose on day one: your business structure. The entity you pick has absolutely massive tax implications down the line. Let's look at two of the most popular choices: the LLC and the S-Corp. With a typical LLC, every single dollar of net profit gets hit with that full 15.3% self-employment tax. Ouch. But check this out. With an S-Corp, you pay yourself a reasonable salary, and only that salary gets hit with payroll taxes. All the rest of the profit can be taken as a distribution, which is not subject to self-employment tax. For a business that's making good money, this one difference can save you a fortune every single year. Now, for business owners who also own commercial real estate, there's an even more advanced next-level strategy called cost segregation. And this is not just some accounting trick. It's a full-blown, engineering-based study that literally dissects your property into all its little pieces so you can accelerate your depreciation deductions like crazy. And this table right here illustrates just how powerful it is. See, normally, a whole commercial building gets depreciated over 39 years. But a Cost Seg study identifies all the stuff that isn't the core structure. We're talking carpeting, special lighting, even the sidewalks outside. And those things can be depreciated way faster, over 5, 7, or 15 years. What this does is it pulls massive tax deductions from way out in the future into today, which dramatically improves your cash flow right now. It's just like Rochester Wealth Strategies puts it here. The entire goal is to boost your cash flow by speeding up those deductions and pushing your tax bill way down the road. You're not getting rid of the tax forever, but the value of having that cash in your pocket today instead of the government's, well, that's immense. Okay, that brings us to the final critical piece of the puzzle, securing your legacy. I mean, it's not just about building wealth, right? It's about making sure you can pass it on efficiently without Uncle Sam taking a giant slice of the pie. One of the simplest and most effective ways to do this is with the annual gift tax exclusion. For 2025, that magic number is $19,000. This means you can give up to $19 grand to as many people as you want, your kids, your grandkids, a nephew, anyone, every single year, and it doesn't even count against your lifetime estate tax exemption. It's a super simple, methodical way to start shrinking the size of your future taxable estate. Now, for larger estates, a more heavy-duty tool is the Irrevocable Trust. When you move assets into one of these trusts, you are legally taking them out of your name. You don't own them anymore. And because of that, they're no longer part of your taxable estate. This can protect those assets from creditors and, crucially, from those big estate taxes, making sure they go to your beneficiaries just the way you planned. Okay, we've gone over a ton of powerful strategies, but a huge part of any smart tax plan isn't just about saving money. It's also about not drawing the wrong kind of attention from the IRS. You want to play good offense and good defense. So what are they looking for? Well, according to former auditors, here are the big ones. First, just missing or underreporting income. They get all your 1099s, so they already know. Second, huge unexplained swings in your income from one year to the next. Also, claiming business losses for years and years can make them think it's more of a hobby. And finally, taking deductions that are just way out of proportion to your income or seriously lowballing the value of assets in an estate, yeah, that's going to get a second look. So, how do you defend yourself? It all comes down to one word: documentation. Keep meticulous records for everything. Seriously, if you do have a big jump in income, you can actually add a note to your e-filing to explain it. Have a receipt or proof for every single deduction. And if you're valuing something like a private business for your estate, get multiple professional appraisals to back up your number. Your best shield is always a good paper trail. So, if we boil it all down, the most important thing to remember is that tax planning is not a once-a-year thing you do in April. It's a year-round process. Max out those retirement accounts. Make sure your investment moves are tax-smart. Pick the right business structure from the very beginning. And hey, don't be afraid to get some professional help to pull it all together. And that really brings us to the final question you need to ask yourself. Is your current tax strategy just reacting to what happened last year? Or are you proactively engineering a strategy that's built to optimize your financial future? Because the difference between those two mindsets, well, that's the difference between just paying your taxes and actually building lasting wealth.